right, cool. Yeah, so if you guys have questions for August, go ahead and either put in the chat or raise your hand digitally, and I'll call on you to unmute yourself. In the meantime, I'm gonna go back on the chat here to see if there were questions that came in. I see Sal, are you available to come on? I see you have several questions and comments, and do you want to come on live to ask your questions, Sal?
I am
Sal.
I am here. I am live from Miami. Can you hear me?
Yep, yep,
Yes?
yep,
Can you see
yes,
me?
yes.
Welcome, August. Long time, first time.
How you
Great,
doing, my
great to
friend?
see you. I've always wondered about the
Absolutely.
Canadian thing, that you're doing a great job. We're doing the same thing. We're doing our first real estate deal in 5 years. We sidestepped everything and we're going to Class A industrial. What I was asking for you is when you're in a group right now, where do you ascend from here? Are you always going to be dealing in residential? It's going to get more and more crowded as the American government has GSEs to sponsor this. And I know for us, for our family office, the 13 families we manage money for, they don't want tenants poorer than they are today. And that's, I think, a consequence of them losing a lot of money in New York City residential real estate during the pandemic. What say you?
Yeah, Sal, great to connect, my friend. And we were connected on LinkedIn. We've chatted
Yeah.
many times as well. Yeah, so there you go. That's the LinkedIn's power
Love
right
your
there.
insight. Yeah, yeah. It's a
Of
pleasure and
course.
a privilege. Yes.
Yeah, no, of course, privilege is all mine. But yeah, as far as our investment thesis, we are very bullish on U.S. rental market. Now, how do
Mhm.
you want to get into that space? If it's core plus, value add,
Yeah, yeah.
opportunistic, it doesn't really matter.
Okay.
It's understanding what is your team's expertise. So you can't just wake up one day and want to do industrial
No, no, no.
multifamily. So
I like that. No, that's a great
yes.
question. That's
And
a
market as
great
well.
question.
Market is
Mhm.
another thing as well. We're in
Yeah,
Texas, we're in Florida, but we can't be in every market in Texas and Florida. So we're hyper focused on
good.
Tampa. Tampa is
Mhm.
3.2 million people, great live and work balance that exists. We know all the brokers in Tampa. We have a couple of deals in the
Good
Tampa
schools.
market.
Yeah,
Yeah,
good
good school.
schools.
So if
Yeah.
there is a
Yeah.
build to rent deal that we have an
Mhm.
understanding of how build to rent works in the Tampa
Yeah.
market, we'll jump on it. Vice versa,
Mhm.
same thing. We closed on our first build to rent deal in San Antonio. We know the San
Yeah.
Antonio market, we understand it, but now we're looking at multifamily value add deals in San Antonio. So I would say
Mhm.
we want to be as specialist as much as possible rather than being
Okay.
oddly all across the nation, all asset
I agree with
classes.
you. I
Yeah, but
agree
I'm
with you.
saying another thing about CPI also is when we first started out, we were a multifamily focused firm. As soon as build to rent came into the picture, I went back to the team and we followed the book Traction and the EOS
Yeah, yeah.
Entrepreneurial Operating System, Gino Wickman, and we've built our company around it. And it talks about that focus of what it is that you do. So I went back to my team. I'm like, now that we're doing build to rent, we're no longer a multifamily focused firm. Our idea of owning 30,000 multifamily doors over the next 10 years, our big, hairy, audacious goal, might not be as focused
Yeah.
as right as possible anymore. So I would
Yeah.
say long term, CPI is probably going to behave more as a real estate private equity firm. But before
Okay.
extending and overextending ourselves, we want to master these two asset classes, multifamily value add, build to rent in specific markets and grow from there.
Uh-huh. Yeah. No, I think you hit the nail on the head there. We're just capital allocators. We don't do any building. I don't deal with contractors or anything. So
As
it's
capital
very easy.
allocators, you cherry pick the best deal with the best sponsor in the best market. It allows you to be
We,
nimble.
yeah, I
So
just put something up in the chat if you want to see it. It's not for everybody, but we're working with a very prominent family on our first industrial class A real estate deal in 20 years. One question here, because I know there's a lot of syndicators on here, and I talk to a lot of people and they call up to lick my brain, is what is the current revenue structure for CGI? Like it's CPI. So, when money comes in, are you using a traditional 2 and 20? Or how are you incentivizing your larger investors to help you scale?
it's deal dependent. So on the
Okay.
multifamily deal, we do your traditional 70-30 split. And then we do preferred return, certain 8%, 9%, 7% preferred return. And
Mhm.
sometimes we have a secondary hurdle, but simple enough is 70-30 split with a 7% or 8% preferred return. On
Mhm.
our build to rent deals, there's more meat on the bones. So
Mhm.
that is a 50-50 split after they had a 12% preferred return, and our LPs are achieving 28% IRR on our build to
Wow.
rent. There's more risk
Yeah.
associated with build to rent than
Oh, yeah,
multifamily
yeah, yeah,
value add,
yeah,
obviously.
yeah.
It's really deal dependent. Keep in mind, if we do have bigger investors like fund of funds or a JV partner, we then allow them to participate in our GP stake. So
Yeah,
their
yeah.
LPs are at par with our LPs. They're at par with common equity, but then they dip into our pockets. So you can
Got it.
structure a deal in any way possible. Sometimes we look at a deal and I go back to Paul. I'm like, hey, Paul, can we do an 80-20 split to achieve our 20% AR to make this deal work? So we're willing to drop our splits to make a deal work if deals are not penciling. So it really is
Yeah.
really deal
Yeah.
dependent.
And okay, and do you have a fee? So when if I were to give you a check, say for $100,000, does 100% of that go towards the fund, the asset? How are the fees managed? How do you keep the lights on?
Yeah, there's fees associated with
Okay.
our deals, like most other private equity deals. So
Mm-hmm.
there is an acquisition fee that is taken up front, that is from the capital raised. So we factor
Mm-hmm.
that in into it, and then there is an asset management fee, that's ongoing fee, that's performance based. So it's a
Capitalized.
portion
Yeah.
of
Yeah.
yeah, it's performance based. It's coming from the cash flow the property is producing, and then the promote or the carried interest is what's
Yeah.
gained from the percentage of the upside. On a development deal is a bit different. So a lot of
Mhm.
fees are front loaded because there's development management fee, construction management fee, acquisition fee. So there's more fee heavy on the development deal, but those are
Mhm.
only released if we hit a certain milestone. They're not released immediately and upfront in most cases.
Yeah, makes sense. All right. Sounds good. I got to jump off. This has been great. August has been
Cool, man.
great. Tim, you're not bad either. Thank you guys. I'll talk to
I
you
love you,
soon.
pal.
Greetings from Miami. I'll talk to you. Bye.
Hi, buddy. Okay. Any other questions for August? Last chance.
No questions, really?
Vanessa,
Hi,
go ahead. Okay,
Tim.
Vanessa and then Jeff.
I can
Oh,
ask a quick question.
we have two other people that raised their hand. So can we have you go
Oh,
third?
Sure.
Okay, great. All right, June. Okay, Vanessa, you go first.
Okay, thank you so much. Really quick, thank you so much for all of the insights and everything that you have taught us today. Thank you so much. I wanted to ask you for recommendations, I guess, on your favorite books and podcasts for that have influenced the most your success, especially books or authors in general. And if it's mindset or business in general, I would love those areas in terms of recommendations, please.
Of course. So I would really say that when it comes to wanting to excel in this space, all of you here, I'm assuming most of you want to either grow your own portfolio or become fund managers or grow yourself as a fund manager, grow your A. So you're fiduciaries to your investors. You're no longer just investing your own money, you're investing other people's hard-earned money, and which affects people's families and what have you. So it's very important about you educating yourself in this space in every aspect of it. Real estate private equity has really three main pillars, right? You got the capital raising, which is connecting with investors, raising money and what have you. You got the acquisitions, which is connecting with brokers and deal analysis and what have you. And you got asset management, which is making sure that the business plan is going to be executed. So having an understanding of all those three pillars is very important, not to just be a specialist, because even if you're allocating capital or managing a fund of funds, you want to have a good understanding of all of those pillars. When it comes to books, there's some foundational books in the syndication space. There's Hunter Thompson, Capital Raising. I'm not sure the exact name of the book, Raising Capital, I believe it's called. It's a great book that gives you an understanding of raising capital and how to go about doing so. And then you have the best ever book, best ever apartment syndication book by our good friend Joe Fairless. So that's a great book to also foundational book to utilize. I would also recommend Traction by Gino Wickman, which is usually for companies to scale, but even if you're early on in your venture, it's good to see how these companies are supposed to scale. So it's a great book to utilize. So those are some of the great foundational books to use in this space. When it comes to podcasts, certain podcasts that I listen to is the Gray Capital, Gray Report by Spencer Gray. That's a great one. It's a weekly podcast that comes out. It's pretty sophisticated and it could be a little bit boring at times, but it's the best hour you spent all week because it goes over all the current events that have taken place. Another great one is the Willie Walker. Walker and Dunlop's founder has his own podcast, which is great. He brings on expert guests talking about all subject about commercial real estate. and other topics as well. Another recommendation I make is on this call, there've been lots of jargon that's been thrown around. If one of those words doesn't really make the concept doesn't really make sense, if you just jump on YouTube or podcast platforms and understand what that is, like waterfalls, like when you talk about waterfall in private equity, what does that mean? Or preferred returns, going down those rabbit holes and understanding those terms will be really helpful. You don't want to use like these complicated terms when you talk to investors at some point when you're raising money, because that actually scares people off. The simplifying is the best way to go about it, but you yourself understanding how they are is a great way to go about. So I hope that was helpful.
Super helpful. Thank you so much.
Of course, my pleasure.
All right. Thank you, Vanessa. Jeff, go ahead.
Hey, August. Jeff Cassell, how you
Hi
doing
there.
today?
Great.
I was asking about your San Antonio assets that you're building. Is that your typical what you like to do is the BTR build to rent, or you want to buy something done and just manage it?
Depends on the yield that it provides, right? There's a risk profile when you talk about development because there's so many other things that could go wrong. With our relationship with our development partner is a relationship that we've been building for a year and a half. We met him at a conference in Toronto and we kept meeting each other and talking about the model. We were not familiarized with the model they had, which is buy a piece of land, entitle it, do all the horizontal, build it while they're building, pre-sell it to these end users who are paying a premium for this because it's turnkey. And then as soon as certificate of occupancy, these things would be sold. It wasn't a model we were familiar with, but the more and more we did our DD, the more and more we went and looked at other projects that they had going on, we felt comfortable enough to put together a project-specific fund and come on board and partner with them. They're also very transparent, very open. They weren't giving us a hard time over contracts going back and forth. So it was a model that we were achieving 28% IRR for our LPs, which you want to be able to get those higher numbers close to 30% if you're doing a development deal because there's most risk associated with development. Is there one particular model within build to rent that I personally like more? It really depends. It really depends on the risk profile, on the length of the term of the project, depends on what it all entails and what type of yields are you able to achieve for your LPs. There was another project in San Antonio that I spoke about, and that project was a DR Horton project, which was built. They stabilized it themselves. They did a terrible job. They were at 85% occupancy. The rents were well below market. So there was a value add right there that we could have gained just buying it from them, but somebody came and just scooped the whole thing up and closed in 15 days. It was an exchange buyer that the broker told us. So on that deal, we were achieving 15% AR. It was a 6%, 5% cash on cash. So am I willing to present a 15% AR deal to my investors that is a brand new built single family with amenities, beautiful property in the best part of town in San Antonio? Of course, because the risk profile is so low, right? Your cash flow, you can put a great debt on that thing, set it and forget it. So yeah, I love a deal like that. But now a bit more risky deal, which is achieving almost 30% IRR and a 2-year time horizon on a development deal with a seasoned developer, yeah, I would love to jump on a deal like that as well. So it really depends on what the deal entails and the risk profile and the exit and all that stuff.
DR's corporate office is about a mile from where I sit right here. So if you want to know a lot about those guys, I do know the main players there, and I've sold probably 3,500 properties with them. So if you're looking at developments, I used to sell out their developments to California investors. I was a national speaker going all over California and following Trump behind Kiyosaki at the Learning Annex tours. So I can sell out your development if you're wanting to do something like that.
Love to connect, Jeff. Please send me a message on LinkedIn. I put my profile in the message earlier on, and let's get on a call, man.
It's already done.
And next time you're based in Arlington. Yeah, next time I'm around there, I'll send you. Maybe we'll go grab some steak or get together.
Sounds
Sure.
great.
June Gray, you up next? You still there?
Yeah. Just another call. Quick question for all you great syndicators out there. My hero is a fellow by the name of Sam Zell, who unfortunately has passed on. If you know this gentleman, he was called the Grave Dancer. And I'm wondering if anybody out there specializes in buying discounted debt. We have so many people like Harry Dent, I don't know, about 1,000 others saying that things are going to crash, et cetera, et cetera. Okay, that's a whole industry by itself, by the way. But the reality is that there's a lot of deals in the United States, and we're involved with Western Pacific out of Vancouver, about $4 billion worth of deals that they've done. And August is one of the people that feeds to them. Okay. Now, if you buy discounted debt for projects in trouble, for companies in trouble, banks in trouble, you're looking at a very high rate of return. And we have funds that we go into things like this. And of all the things I've tried over the years, this has the highest probability of making money. And I'll just turn it back to the group here, because this is where you can do a year's income on one deal in a matter of weeks. And you can also have a few problems. Your turn.
So was there a question, Juno? You're just letting us know.
Yeah, who's out there actually? Look, all these guys talking, they're putting big deals together. The reality is there's 56% of them are losers or going broke. That's where the real business is.
Where is the June? Where is the market for these? Is there a marketplace for it? How do you get your hands on them?
Because in Canada, Jerry Schwartz, Prem Waza are our heroes. And there's people down in the States that also specialize in buying debt. Kevin O'Leary does this, by the way. Okay. Any of these names ring a bell? Going partners with these people can be very lucrative. And I'm wondering if anybody else has that way of finding and putting deals together rather than buying all this stuff at retail.
Yeah, it's a completely different asset. I do know some people that play in the debt side of things. One of my mentors, actually, back in the last recession in 2008, 2009, his fund bought one of the 12 companies that were buying debt directly from Fannie Mae and coming into distressed banks and buying up their real estate portfolio debt, real estate notes. And so, yeah, so I do know people who play in that, but this market's actually quite different from that last market crash. I have one of my friends who he's been a banker for 30 something years, and he's owned banks and sold them and things like that. This market's is different in that banks have, like, they're able to liquidate things a lot easier. It's not like what it used to be. So I don't know anything much about the debt market. August, do you know much about the debt market?
I don't know much, but what we look at institutions and see what they're doing. And when Blackstone started out years ago, decades ago, they were a mergers and acquisitions leveraged buyout shop. So they would buy companies, and that's what all their focus was. And then Blackstone got involved in real estate, and they started buying so much real estate. They're currently their largest private owner of properties in the US. And their allocation in real estate was larger than their allocation in private equity, buying companies. They're buying more real estate than they would buy companies. Today, Blackstone has a larger allocation to debt than they do to real estate or private equity. The debt space, it's a space that there's always money to be made, but it's also important to note, when June, our friend, was talking about this, is that if somebody who's provided debt is trying to sell that to you at a discount and walking away from it, that should also ring alarm bells, right? If somebody was sophisticated enough to give this debt in the first place and they don't feel comfortable and they're walking away, what is it special about you that you feel that you can take it over and do better? Can you foreclose on the borrower and take over that property? Is that your competitive advantage? So you got to see what it is. If it's just an idea that has come there and there's lots of money in it, it just sounds like a shiny object syndrome, right? But there's a lot of money in that. Two ways of answering the question.
That's really good. I didn't know that was the direction Blackstone's going into. That's cool. Okay. Dallas, go ahead, unmute.
Thank you very much, Tim, and thank you very much, August. I feel very honored I've known a number of Canadians. I'm in Southwest Florida, like yourself. I really appreciate my Canadian friends, especially redheads. Anyway, so I'm about 90 miles south of Tampa. I did have a question. Now, your master funds, your U.S. master funds, did y'all do the U.S. master funds, or do you have someone in the U.S. that did the master fund?
Yeah, no, and keep in mind, when I call it a fund, sometimes there is a confusion when it comes to fund and syndications. Even though I'm calling it a U.S. master fund, that's still a project-specific syndicated vehicle. So it's just a U.S. limited partnership that's been put together just for that one deal, even though we call it a fund. So yeah, as far as us putting those funds together, the fund is owned and managed by us, who are the general partners individually. So a U.S. Securities Council, a U.S. Corporate Securities Council is who puts together that U.S. master fund for each deal that we syndicate. Yes.
Okay, I got it. I thank you for that. So now on to Southwest Florida. I do have a little project that I've got the pieces of, and it'd be a built to own. You see, it's just about a half a mile from my house. There's 3.88 acres that's already platted for $600,000 for 13 units on it. And I have a builder that would build. And let's see. Yeah. So is that something you might be interested in?
It might be too small for what we look at, but I'm happy to look at any deal and give you at least some feedback. We look at something between 50 and 100 doors. The projects we look at, it just makes the economic sense to go through the trouble of putting together a Canadian feeder fund, U.S. master fund, all the stuff we have to do.
Yeah.
So if a project is too small, it doesn't make the economic sense to go through that whole process and raise money and offering docs and everything. But yeah, I'm happy to give some feedback. I'm also part-time based out of Naples, Florida, so Southwest Florida, 90 miles south of Tampa. Where are you?
This is Inglewood, out of the Northport, Venice, Inglewood Triangle.
All right. Okay.
You might have passed the River Road exit.
Yeah, possibly. Yeah, I go from Naples to Tampa all the time. We own a property in St. Petersburg. So yeah, happy to look more at it. I can put my email address in the chat. Send me an email because all the stuff with LinkedIn might be a little bit.
That'd be great.
Yeah. Happy to at least give you my feedback. But yeah, so there you go. That's my email.
Okay, great.
Perfect.
I just shot an email off to the realtor. I'll just get on there and copy it off to you.
Perfect. Thank you, Dallas.
All right.
Thank you, my friend.
All right, Dallas. Thank you, Dallas. Okay, we're going to go ahead and wrap up this part of our show today, and then we'll put you guys into your breakout session. August, thank you so much for doing this interview with me today, and really appreciate you coming on and sharing all of your insights and wisdom with us today. Thank you so much.
My pleasure. Thank you for having me.
Okay, thank you. All right, let's do a group picture real quick. Everybody, unmute, not unmute, but turn on your cameras. We're gonna do a group picture real quick, and then let me see. Where is my thing? Okay, good. All right, so you guys ready for our group picture? So we actually flex on this show, August. We flex. There we go. All right, you guys ready? 3, 2, 1. Yay!